Economists have gotten together and they've identified 10 reasons they feel the US has not entered into a recession, talking about the resilience of the country and what exactly is going on in the economy. Will it hold? Will we be able to fend off these interest rate increases from throwing us into the next recession? We'll talk about that right now.
Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a bi-weekly show that aims to focus on the trend lines rather than the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Welcome back to the Trending Report. Today we are going to be reviewing data as of last Friday. That was July 21st. We are also going to talk about the top 10 reasons that's been assembled by a collection of economists to indicate or explain why the country has not gone into a recession yet. That's kind of an interesting perspective given all that's occurring. And then also we'll take a look at just how the U.S. is holding up against other countries. And then, of course, as always, we're going to get into the specifics numerically of what's going on in the stock market from a capitalization standpoint, from a sector perspective. Internationally, we'll take a look at equities, and then obviously we'll wrap things up with the bond market. So let's jump right in. Now, as I mentioned, there is a collection of economists from UBS and other places that got together and talk about the 10 different components that have kept the U.S. out of a recession. Government spending has continued. There's been strong savings. There's been a resilient job market and numerous other pieces that relate to that. So the monetary policy itself has not become all that tight yet. Government spending is back on the rise. Savings for the U.S. Continue to hold true since the pandemic. And then debt levels are not too high and credit conditions haven't tightened that much. So here, what you're really seeing is the impact or lack of impact that the interest rate increases have had. So although interest rates have gone up on lending, what you've seen is that the banks are still willing and wanting to lend. Unlike sometimes when the banks start constricting on their underwriting policies because they want to make it more difficult for someone to get that loan, right now you're still able to get it with relative ease. That's always subjective, but it hasn't tightened up in that sense. We've talked about the labor market quite a bit in previous trending reports. We continue to see hiring. We continue to see unemployment falling below that 4% figure. Again, 4% is kind of a magical number in the labor market because generally speaking, as economists sometimes say, approximately 4% of the people simply do not want to work. So if you can get it below 4%, you're usually doing pretty good. And we continue to see that being the case. Various economic trends have started to stabilize. And then this is kind of an interesting one. There have been downturns in the various sectors. So we always look at the stock market through the lens of the 11 different sectors here on the trend report. And the theory here is that certain sectors have seen a downturn, but overall, the other sectors have buoyed up the market. So you haven't seen all the sectors going down. So it's almost like instead of seeing a mass recession across the economy, you're seeing pockets of decline, and that has been offset by growth in other areas, keeping us out of that recession category. And then the services industry continues to be solid and grow, and the economy seems to be less cyclical right now than it had been in the past. Some of that is through, in my opinion anyway, through the variation of how we're operating today prior to the previous to the pandemic. So the way deliveries are taking place, the way the logistics string works for getting goods to your home, what's going on in that supply chain, what's going on in the kind of the backing up of that, and the ease to access that. So although there might be empty shelves, there are full warehouses, and being able to kind of match those together as you're running your household. Now, All of this comes under question, and many people tend to question, especially when things get a little weird, as they have been for the last few years. They tend to question, do we have the right formula? Is the United States running things the way they should? Is capitalism truly working? And some loud voices out there in social media on one extreme or the other will argue against that. And I will tell you that it's really a bunch of BS. I mean, there is no better business model. There is no better economic model. There is no better government model than what we have in the United States. Can things be improved upon? Of course they can. Do certain politicians drive us insane with their ludicrous ideas? Of course they do. But nonetheless, the system itself is very solid. And when you stack it up against the world, you see how solid it truly is. So here, we're ranking countries by GDP per capita. That means taking the GDP, the gross domestic production, and then dividing it into the population to determine what is it per head of population that you're seeing in GDP. And these are the top 10 countries ranked across the world. And what you'll notice here is that, first of all, the majority of these countries have very free capitalist type economies. The US is coming in over here at number 7, but the US really stands out with its population. You'll notice that all of these other countries are significantly smaller. In fact, if you took all the other 9 countries, added them together, the US is still 5 times bigger than the other 9 combined. And crazy multiples bigger than some of them. So here's Luxembourg, number 1, but they have less than a million population. Ireland has 5 million in population. Norway's also in the 5 million range. Switzerland's at 8, Singapore at 6, Qatar at 2.7, Iceland at less than a million, Denmark at 6 million, and then Australia is the second biggest out there. But at the second biggest, they're only at 26 million versus the United States at 340 million. The reason I feel that that's important information is because the systems can oftentimes be very successful at smaller populations. The key is, can they be successful at larger populations? And the US is head and shoulders above the rest of the world when it comes to looking at large populations who are successful in the GDP per capita calculation, which basically is the best way to look at an economy to determine if it's strong, if it's vibrant, if it's growing, and so on. Now, the US is in the top 10 list here, number 7, as we talked about on this ranking. If you look at, quote, the most powerful countries, the top 5, number 1 here is the US. And then number 2, 3, 4, and 5 are China, Russia, Germany, and the United Kingdom. Now look at the GDP per capita in China. $12,500 versus $80,000 in the US. And they have 1.4 billion people, where we only have 340 million. Only is a subjective comment, obviously, but we have 340 million. Russia is in that $12,000 range again, but they are only 1/10 the size of China. So I think that's pretty interesting. You know, here you have essentially 2 communist countries who are operating at 10 times difference in terms of their population size, but their GDP is just about identical. So you wonder, you know, is that by coincidence, or is that just how that type of government is able to create output? Germany, you see a nice big jump up here. They get to 50,000. United Kingdom is right near them at 47,000. They've got 83 million people, 67 million people. But again, the U.S. really stands far and above to be the number 1 powerhouse in the world, and still in the top 10 on rankings for GDP per capita. So that tells me that the system and the economy actually works. It's rock solid. It holds water. It's performed over the long run. And some of these people who want to argue that other countries have figured out a better formula, they need to visit this page and do their math. Now, with that being said, let's take a look at what's going on in the markets. So here we're looking at a 1-year view of the capitalization. So that means we're going from large cap down to small cap. The overall stock market is indicated here by this blue band. And it's also the graph that we see here. And what these rankings are telling us, when you see all green like this, it means that things are leaning bullish. They're tilting bullish, both on the short-term swing as well as the long-term trends. The market itself, you can see, is being lifted by the large caps. Here's the S&P 100, the S&P 500. And then if you look at right beneath it, we also see the S&P 500 growth and value are here. And then if we go the other direction from that break point, you'll notice that everything down here is small cap and mid cap. So it's the large cap that's really lifting the market right now, and it's continuing to be so. And then here you look at these support lines. So here's a support, here's support, here's support, here's support. And they're just working up very nicely here. And then this is resistance. But look, we've blown through the resistance here. We're significantly up above that resistance right now. And that's why you see green on the swing. That's why you see green on the trends. Now, if we take a look at the sector viewpoint, here we're looking at the 11 sectors. We take the equal weighting of the sectors. Now, again, sectors are not equal weighted. The information tech is the largest sector by a long shot, for example. Real estate is one of the smaller sectors, and so on. But if we look at those equally, you can see again that there's some nice support taking place here. We've got this resistance right here that's been blown through. We're still seeing both the swing and the trend are showing green. We are getting a little bit of red down here in the trends with energy and utilities. Information and industrials are leading the way. You may have noticed the Dow has been doing quite well recently. That's why that's showing up there. And then that's kind of offsetting what we're seeing down here towards the bottom. And if we then take a look at international, we're seeing all green as well. Not quite the spike up that we see on the overall international market compared to the US, but again, still trending nicely up in that direction. The swing here is more recently tilting towards the bullish, but the trend has been strong bullish going back to December of last year, which again visually makes sense when you see it here. And then finally, when we look at the bond market, we are seeing the short-term swing. If you recall, the last time we visited, the short-term swing had all kinds of red in here. It has now turned green on the bonds. The trends are still coming in at red. And again, when you look at the trend, you're coming down here. When you look at the swing, you're coming here. The overall bond market right here in the middle, we are seeing this resistance and we're seeing this support, and you can see it's a ranging market. It's just kind of working its way across here. That being said, we are seeing corporates that are lifting the bond market up, and we are seeing treasuries or government bonds that are bringing the market down. It is an absolute split right here. So here's the overall market. Everything above it is corporate. Everything below it is government. So that is a very definitive split that we're seeing in the bond market. So lots going on. There still continues to be tremendous volatility in the market. We're not out of the woods yet with interest rate increases and the Federal Reserve. We are anticipating future interest rate increases, especially when they see that the employment market is not softening, that labor is not softening. They believe, generally speaking, that means they can continue to raise interest rates. But then the flip side of that also is, in my opinion, you can't just look at that one factor, which is what they tend to dwell on most often, because in looking at that, you're kind of throwing out the resilience of the economy. So you don't want to overdo it, push it too far, and then have it fall off a cliff on you. So no doubt they will be watching that with future increases. And we will be keeping you up to date as we move forward.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.